Well, good morning, everybody. This is Daen Wombwell from NRW. I'm just going to unmute the mic of Buck Cowan. Buck, I'm just doing a voice check. Could you please raise your hand and let me know that you can hear me clearly? Thank you, Buck. All right, then. So we'll make a start. Today's webinar is going to focus more on the business side of the Kaizen and Trizen programs, building on the webinar from last week. And this is particularly trying to drive home the conversations that you'll have with the C-suite or the decision makers about some of the impacts of the program and how it can affect them from a business perspective. So we're always balancing two parts of the sale when we're talking to the business owners. On one side, it's what is in it for them personally, and then it's what's in it for the business, so that they can show good governance and good management of the operation. And if you think about that in context, we keep hearing on the news every day about benefit plans that are failing or have become so cost prohibitive to the company, they are fundamentally impacting the company's performance. And what we're focusing on more today is the bigger kind of companies. Some of this is applicable for the smaller companies as well, but in particular, some of the balance sheet type stuff that the bigger companies are worried about. We're still doing this in the context of the value proposition of bringing more money to the program than they would otherwise as a business be willing to allocate to the benefit of their core employees. So just as a reminder, we have the situation where we've got a kind of a difference of perspective between employee and employer. From the employee perspective, we know that the large number, 90% plus of highly compensated employees are not saving enough for retirement. So put it into context, all those doctors, lawyers, CPAs, architects, high-tech engineers, all those kinds of people have worked very hard, made great sacrifices to get to where they are, but statistically at least, a technical phrase coming up, their retirement is going to suck by comparison to their current lifestyle. So there is a genuine need out there. We know they're supposed to be saving 34% of what they make. We know they're not. And so we know there's a fundamental gap. And so the key value proposition or differentiation of Kaizen and Trizen is that they're the only plans out there bringing additional money to the game. Everybody else is trying to figure out how to spend the budget they have more effectively when they all know the budget is insufficient. On the other side of the coin, we know that from the employer perspective, that 16 million people are leaving the workforce over the next 10 years. We know that the CEO's report, I go to, for my sins, which are many and varied, I go to quite a few CEO type forums. That way I can make myself feel important and hang out with people who are brighter than me. But one of the recurring themes is this genuine concern that recruit, retain of key talent is going to be the number one priority over the next few years. So they're already feeling the pinch on getting and hiring skilled labor. If you're in the Dallas area, a very fast-growing part of the country right now, it is really, really hard to recruit quality people. So if it's going to get worse over the next 10 years, you can see why more and more executive teams are really worried about the quality of their talent. So we know that headhunters will be targeting key talent, and we know it's going to get worse. So you've got this situation where, as an employer, and most of you on the phone run your own businesses and are employers, if you think about it, you know you need to pay more to keep your key people, but paying more is going to impact the profitability and long-term profits of your business, because once you pay it, you can't take it away. So you're caught between this rock and a hard place. You've got to stay competitive, but the other side of the coin is costs will be going up because of this dilemma. So if we summarize, what are we really bringing to the party here? The whole point about the more money is enough money to make a big difference, that people won't change for 10%. So Kaizen and Trizen are bringing about 60 to 100% more income net of everything. And I added one line into this, and that is, we talk about supplemental retirement, we talk about bonus plans, but we're also talking about traditional IUL sales in the business context. Many of you are selling IULs in a business context right now. The bottom line is that sale is always constrained by how much money the client has available to spend. And all we're doing is building on what you're already selling and just adding more money to allow them to get more out of it. More protection, we had the usual stuff that we've talked about over the several weeks, but the thing I added here is more protection against the loss of your key talent. If you're the only employer that has a plan like this, you're able to compete and punch above your weight because you basically are outspending your competitors in terms of the perceived benefit that the employee is getting. They'll think Kaizen and Trizen is predominantly coming from the employer perspective, and so it gives that employer a competitive advantage versus others. So building on that, there's no point in having a benefit if nobody believes it's actually going to happen. So as I mentioned last week, only of the stock portfolios out there, if they're highly diversified and run well, they only have about a 72% probability of actually beating bonds. So against that backdrop, if I don't have enough money and my probability is only 70% of winning, I've got an additional risk on traditional plans that our designs in Kaizen and Trizen address. But it also allows you to get around the issue of poor insurance designs. If you have bumped into a few employers who have bought insurance plans in the past, a lot of them are saying they're underperforming. And it's largely due to the design itself, either short pays where they've done a 3 or 5 pay, where they've been funded at target premium, or they're using products that are just not yielding and unlikely to ever yield enough return to really generate the outcome they were hoping for. So poor design is not just about surviving Great Depressions, it's against the competition that we run into out there. The only difference between that, as far as Trizen is concerned, is it's really addressing the supplemental retirement and deferred compensation because it's a pre-tax plan using loan regime split dollar. But there are a fair number of non-finance loan regime split dollar plans out there. In every analysis that we've run, the Trizen plan will substantially beat it just because it has more money to play. That's the only difference between the two there. One of the things that we're getting a lot of questions on is you guys as a group are highly creative, you're very entrepreneurial, and one of the benefits of that is you think of lots of things. One of the detriments of that is you think of all the different opportunities that are out there. One of the things that every business planner will tell you is that successful people focus on the core low-lying fruit. So what are they? We're really targeting financial services, CPA firms, hedge funds, banks, credit unions, all those sorts of things, medical groups, legal services. I can't tell you how many law firms, it's ironic when you think about how bright and knowledgeable lawyers are, about how poorly they've executed their own succession planning within the business. There are a lot of sales of law firms not going through because they have significant underfunded partner buyout plans. So basically all those big bonus checks they've been taking through the years are the very thing that's meant that they haven't funded their own succession plan. So big opportunity in the legal services area. And high tech. If you're out in California or one of the high tech incubator areas, you'll know that the average job duration of the good engineers is less than 2.5 years. So if you think about how long it takes to get a person up and running in your business, they just get up and running and then somebody takes them and they move. Well, this is not efficient. So in a marketplace where skills are short, and these are 4 of the areas where there's a skill shortage, we have a particular attraction. But what we're really interested in is the fact that these sectors have the highest concentration of the people paid over $200,000. So it's not that there aren't other opportunities out there. It's just this is where we think that from a sales point of view, you'll get most bang for buck and start to get what we were talking about in our university earlier on this year, not the one life, but the 5, 10, 25, 30, 50 type life applications where your sale just goes up by an order of magnitude. I can't remember, but I think last week I was talking about a case I'm working on. It's just a local firm where I happen to know the CEO. There's only 15 people there, but the average salary is $1.5 million. So if those 15 people do it, that premium for that particular case is $4.5 million. If they just do 10% of their salary. So big opportunities, we would recommend this is the area that you focus on. When we're looking at the company types, we typically break the programs into two categories, and this will come to have some relevance later on in the presentation. But with Kaizen, the vast majority of corporations out there are S-corps, pass-through tax entities. So Kaizen's a better fit for those. But really, when we're thinking about those, the medical or the legal professions, CPA firms, typically you'll see those as partnerships or LLCs or S-corps, and that's where Kaizen has a play. Whereas Trizen is really focused on the C-corps and not-for-profits. We'll explain why in a second. We get a lot of questions right now. Having looked at Trizen, a lot of people asking us, why wouldn't somebody use Trizen in an S-corp? So just to answer that question, there's so many questions, so many people have been asking that question, just look at that in context. And I want you to think of yourselves as an owner of an S-corp or an LLC. So revenue comes into your business and you have some costs and all the rest of it, and you have some profit, but as it's a pass-through tax entity, you personally are paying the tax. You and the owners of the company are paying the tax on it. So that would then mean if you're going to do a loan to any of your employees, you've personally paid the tax on the loan that's going out to the employees, but you haven't got the money for it. So you haven't been paid, but you've got the tax bill anyway. And this is why the vast majority of S-corps wouldn't do a loan for their employees. They might, if the fact pattern dependent makes sense, do it on themselves, but for the most part it's unlikely, in which case it's practically a Kaizen case. For the most part, it just doesn't make sense. And this is true for LLCs unless the LLC is taxed as a C-corp. Okay, so that's the reason. We just get asked that question a lot, so I thought I'd throw it into that. So with that sort of introduction, let's position this in the context of the new tax code. By the way, I forgot to say, this presentation, I hope, based on the timing, is relatively short, so we shouldn't keep you as long as we normally do. So hopefully that will be good news to you. So let's look at positioning with the new tax code. So what are the bits that we're interested in the new tax code? We know that corporate taxes were reduced from 35 to 21%. Now that's a great thing, right? Well, it may not be, and we'll put that into context. Pass-through entities got some deductions, but most of those are irrelevant to the target markets we're talking about. So that's largely a red herring. Something that will come back again, and it can only be addressed with Kaizen, is the loss of deduction on those top earners or the covered employees. This is something that public companies and not-for-profits are concerned about. And we'll show how you can use that in the context of a sale as we go through this presentation. Not-for-profits are getting an excise tax, which essentially is making the playing field level between for-profits and not-for-profits. These guys lose their deduction. These guys get a tax because they don't otherwise pay tax. So it's just leveling the playing field, but it means that they both have the same concern. Some of the state deductions, or the loss of the state deductions, are potentially will result in more taxes on the personal level as time goes on. Not necessarily right now, but as time goes on. But what we're really interested in is the corporate tax, and we're also interested in this loss of deduction. So let's look at how this has impacted the ZEN. So Kaizen and Trizen I'm putting under the banner of the ZENs. So if we look at the old rules of bonuses or deferred comp, we had $100 being paid out. I took the deduction for this if I was a C Corp, and that was really costing me $65. Under the new rules, my tax code has gone down, or my tax rate has gone down, so I take the same 100, I get lower deduction, my cost has gone up by about 21% or so. So it's actually become more expensive for bonus plans. So Kaizen and bonus plans, which are the vast majority of compensation, will be affected as they become essentially more expensive to a C Corp to do. If you think about that logically, most companies tend to, if you're a relatively small company, what happens is the owners take the lowest salary they can through the year, and at the end of the year, they distribute the profit as a bonus. And so that bonus just became 21% more expensive if you're a C Corp in terms of your loss deduction. Loan regime split dollar or Trizen or enhanced split dollar for the smaller cases. Again, before $100, I used to pay tax on that because loans are after tax, so it really was costing me $35 or 35 cents on the dollar. Now with the new rules, because my corporate tax rate is low, it's actually become more attractive. So for Kaizen and bonuses, more expensive as a consequence of the tax rules for C Corps, and the Trizen or enhanced split dollar have become cheaper. So that's attractive. So from our perspective, the employee, on the Kaizen point of view, really hasn't impacted them very much. From the employer, what it really hasn't done is made it any different other than it's more expensive, with one caveat. Most of the time, when we do the presentations on Kaizen, we talk about how much better Kaizen is pound for pound than the traditional bonus plan, deferred comp, or whatever we're comparing it with. One of the things we're finding more and more, because of that increased expense, employers were looking to reduce some of the bonuses because it was more expensive for them to do it. And so what you can do there is use that reduced amount to basically put that into Kaizen, and they would have been net still better off than they would have been before the cost increase. So it allows you to sort of do okay, let's reduce the bonus down as an employer, but the employees still get what they would have got before. So if you're kind of turning the tables around 180, it's kind of approaching it from a different angle. On the Trizen side, obviously it's cool because bonuses and deferred comp got more expensive, whereas our cost for providing Trizen or enhanced split dollar just reduced by 40%. From an employee point of view, however, it's really no change. So all of this stuff is stuff that's affecting the employer more than the employee. So if we look at the Trizen example, so when we look at that from an employee perspective, we say, okay, let's look at our 45-year-old standard health. Let's assume our growth rates are in a reasonable range, and let's look at the contributions being a pre-tax contribution of $50,000, so after tax it's $30,000 and change. This is the kind of income flow that you would see from Trizen, right? So substantially better than the bonus and substantially better than deferred compensation. Graphically, it just says the same thing. Obviously, what that really means is that from a Trizen perspective, the employee is getting 220% more. So we know that Trizen became cheaper to the employer, and that's cool. We also know that it's creating an asset to the employer because a loan is an asset as long as it's going to be paid back, which it is within this program. So let's look at that in context. If I have an asset if I have 100 employees, and let's say I'm going to bonus or put $100,000 in a year. Now, in a large public company, that is not a big number. On some of the censuses we're seeing coming through now, this number of 100,000 is pocket change. So this is real stuff that we see out there. But let's just look at it in this context. 100 executives, 100,000 a year, 10 million a year, $50 million being put into the plan. What we did is say, how much would that be worth if this company was sold in 5 or 6 years? So what we did is we took what the accountants were telling us is the right way to approach this. We discounted the future receivable, i.e., when am I going to get that money back, by a normal discount rate that you would use, the fair market loan rate, minus the compounding effect, because the loan's going up by the AFR rate. And that meant that if we wanted to sell this asset, now bear in mind, this was bonus money we were putting out before, or deferred comp. This was a cost before we were spending the $50 million. That would have an asset valuation, a positive asset valuation of $45 million after about 5 years or so. So this is not small stuff, particularly if these numbers get bigger. We're very fortunate that there's a couple of programs being rolled out by some of the larger benefit providers in the country using Trizen, where these numbers are numbers we're actually sitting down crunching with their chief financial officer on how to value these assets for companies that are looking to be sold in 5 years or 6 years. And these are the numbers we're starting to come up with, and this is why I'm throwing this into the presentation. So you see this conversation about the benefit is not an insignificant number. So we're growing the assets of the company while improving our benefit to the employees. Well, that's cool. The problem is with this, I mean, why wouldn't everybody just do Trizen in the C Corp, right? Well, one of the issues we run into is that Trizen isn't available to the top 5 executives of publicly traded companies. And as all of you know, the top 5 executives are supposed to be overly looking at the running of the company, and they do that. But if they're excluded from something, they get a whole lot less interested. Now, why is this a problem? There's this little regulation called Sarbanes-Oxley. Sarbanes-Oxley was a reaction to the Enron scandal. It was never intended to cover loan regime split dollar, but it does, and so we need to react to that. So how can we put a positive out of a negative? Now, I will also caution you, those of you who are working with not-for-profits, that quite a few states have enacted Sarbanes-Oxley-like regulations that covers not-for-profits. So before you push a Trizen solution in the state, then you want to check to see, and I know, for example, that New York is one of these states. Of course it would be, wouldn't it, being New York. So just before you push a Trizen situation in the state, check to find out whether that Sarbanes-Oxley applies to not-for-profit. It won't be called Sarbanes-Oxley, it'll be called whatever the state regulation is for that. So what do we do? How do we fix this issue? One of the other aspects of the tax code was that bit about the loss of deductions. So let's look at how we could use Kaizen to help solve this problem with the top 5. Because the top 5 are typically the most highly compensated. Not always, particularly with medical companies and stuff like that, but typically it's the top 5 that are highly compensated. So the issue that we're focusing on is the loss of deduction on compensation above $1 million, and that includes all things that are rolled under compensation. And this is code section 162M. So let's assume we have a top 5, and they're each deferring $1 million each of their salaries. Now, it's unlikely to be the same, but let's just do this to keep it simple. Let's assume those assets are put into a deferred compensation plan growing at 6.88%. And let's assume that the state and federal tax, so I'm picking on the East Coast and the West Coast here because they tend to have the higher state taxes. Let's assume, just for the sake of simple maths, that the combination of state and federal is 50%. And we know what the corporate tax rate is. So these are the assumptions we're going to plug into our equation when we're doing this. So let's look at how 162M would affect traditional deferred compensation, bonus plans, stock option plans, all that sort of stuff where the 162M rule would apply. So let's put the money in. So it's cost them $25 million to put that money in over 5 years. And if we grow that at the growth rates, take off the tax and all the rest of it, and start taking income out. And what we're going to do is we're going to take the maximum income we possibly can out so that after another 15 years, there's no money left in the deferred compensation plan. So let's say they're taking this money out from 65 to 80. And you can play around with the numbers either way, but the basic logic will still be true. So let's use those as our assumptions. The loss of see, what happens with the corporation is you take the deduction when you pay that money out. So in order to have the $600,000 or so coming out, that means they're going to be pulling out about $6 million a year. And at 21%, that's costing the corporation in terms of lost deduction $1.28 million a year for a total loss of deductions of $19 million. So if you think about it, the 5 executives are between a rock and a hard place here. They're supposed to be running the company to the optimal level for the shareholders, and yet, as a consequence of this tax code change, the plans they had in place in the past to compensate themselves are now going to cost the shareholders, $19 million. Tough one to resolve. So unless you had Kaizen, basically is Do the shareholders suffer, or do I give up the benefits that affect me personally the most? But somebody's going to lose. So how can we position Kaizen as an alternative to this? The first thing we're going to do is we're going to adjust down the amount of money we put into the plan so it matches what they would have got before from the deferred comp. So let's put less money into the plan. So let's put 3.3 million in for the 5 in total. That's $16 million over the next 5 years. So they're getting some immediate cost savings in this example of $8 million. If we look at the deductions, though, Kaizen's a bonus plan. It's paid out immediately. We're not dealing with the compounded number. We're dealing with the number of today. So that 3.3 million times 21%, $700,000, which means that you've taken that deduction loss. They've still got a loss on deductions. It's just far smaller than it would have been with traditional deferred comp. Now, bear in mind, the executives like this because they're getting exactly the same amount of money they were getting. But in terms of savings versus the traditional deferred compensation, they cut that deduction loss down by $15 million. So great corporate citizenship by the top 5 executives, great value to the shareholders for doing it. Well done all around. Everybody's happy. So if we summarize that, we were able to cut the cost down by $8 million just in the amount of money we had to put in to get to the same result, and the deductions were $15 million and change. So by implementing Kaizen, they saved $23.9 million in this example. But the executive is keeping the compensation they otherwise would have, but instead of having to wait it out and hope that nobody sues the corporation and attacks the deferred compensation plan, they're getting it immediately and put into an asset protected. So they're looking like a rock star, but they're also kind of happy because they've got their money also. Now, some of you may be saying, well, that's great, they get their money. What happens if they leave in 5 years? Well, that's no different from deferred compensation because we've only looked at 5 years of spending. But if deferred compensation was going to be every year until they retired, there's absolutely nothing whatsoever stopping you from selling them another Kaizen plan for the next 5 years. And we would strongly encourage you to do so, just to ladder it up. But the point here is, unless you had leverage, this option isn't even on the table. So, as I said, overall benefits, $23.9 million for implementing Kaizen that the executive thinks is a better plan for them anyway. So if we summarize that, where the strategic reason for providing a benefit in the first place was this recruit retain thing, which has been said is the number one issue that executive teams are worried about going forward over the next 5 years, massive advantage by using either of the ZENs. We're able to control costs, whereas pretty much every other benefit is going up in cost every year. We know exactly what our costs are. So that's attractive, a massive advantage again. Create an asset or save employer dollars, either through the 162M approach or Trizen, another advantage that otherwise wouldn't be available. While at the same time, the employees are happy, so that's kind of attractive too. And obviously, from a business point of view, Grace probably, I think she did it last time she presented, but she was also talking about how you actually make more money selling the ZENs. But this is obviously good for you because it means that you've got something that your competitors don't have when you're talking to the C-suite of a small, medium, or large business. It's an advantage to you. All of that being solved just because of the way leverage is being brought to the play. So we say there's a simple throwaway that this is the only plan bringing the leverage. But at the end of the day, it allows us to have something that nobody else has in this space where everybody's offering the same thing they've been offering for the last 30 years. So we think it's a simple thing, but there are very significant advantages, and we're starting to see that with some very large cases that are starting to be rolled out. So Grace is dealing with a case right now where there's 4,000 lives involved, which was largely going to be a Kaizen. I'm dealing with another case which is going to be multiple thousands of lives, which will be a combination of Kaizen and Trizen together, blended as a team. So one of the tips that we're going to leave you with on this particular presentation is that when you're dealing with public companies, it's actually probably a blend of Kaizen and Trizen that will probably be optimal for them. This might be, I could say this just as equally for a not-for-profit. And so we think that the blend of the two gives you some extra play, depending once you've discovered the sort of lay of the land when you're talking with those companies. So I mentioned that this was going to be a shorter presentation this week. That was really just, if you think about it, we really were not focusing on the particular illustrations, the particular benefit to the individual. We were just trying to look at it from a company level. So I will throw it out for some questions or comments or feedback if any of you would like to ask that, and I'll unmute your phones as we do that. So if any of you have any questions, please just raise your hands and I'll try to scroll down through this little thing and answer any questions you may have. Now, David, Tristan, I'm trying to get to you, but my screen keeps updating so quickly that it scrolls you out of the little window I have available. So bear with me a second as I try and find you again. I can't find you for the moment. I'm just going to go with Joe Fuller first as I do that. So, Joe, I've just unmuted you. Do you have a question? Joe Fuller? Are you there? Going once? Okay, I'll remute you and we'll see if we can come back to you later. So let me just scroll down again. Paul Craig, let me just unmute you. Paul, do you have a question? Sorry, I said that wrong. Paul Carrag. Probably butchered your name. I apologize if I did that.
Can you hear me?
I can hear you now. God, sounds like that flipping advert, doesn't it?
Yeah, no, my apologies. There's no question when you asked to raise the hand to test the hearing in the beginning. I raised my hand to let everybody know.
So what was your question, sir?
I don't have a question.
Oh, you don't have a question? Okay, so I'll just mute you back again. Okay. Andre, can you hear me?
Yes, good morning.
Good morning, sir.
My question is, I must have missed something really important because I don't understand how come everything is going up in cost and the Kaizen and Trizen is going to be going down.
Okay, let me just go back to that section if I can. So let me just see if I can do this without messing everything up. So forgive me if I scroll around a bit. Let's go to this slide again, and let's just quickly go through that. So this is really something that's impacting more the C Corp than it is the S Corp in that regard. So let me just go through this. So it's all to do with what you could deduct, right? So if I was bonusing, let's imagine that I'm the C Corp and you're the employee of the C Corp, and if I was bonusing you, the C Corp would take a deduction for that bonus. It's a 162 bonus, and that's a deductible expense. So I would take a $35 deduction in this case for a net cost to me. So it's really costing me, as long as I have deductions I can offset against profit, it's really costing me $65 to give you that $100 bonus. But because the corporate tax rate has gone down, if I do the same thing now, I only get a 21% deduction. So really it's costing me $79, whereas it used to cost me $65. In cash, I'm still paying out the $100. So there's a very difference between cash accounting, so I'm still paying out the $100, but after tax, deductions, and so on, it's really costing me $79 now versus the $65 it was costing me before. And this affects all bonuses. Does that make sense?
Yes, it does. Okay.
So if we then look at loans are after tax expenses, right? So I pay my taxes, which previously was $35. So for the $100 situation, that was really costing me the tax, which is $35. Because my tax rate has gone down, giving people loans now is a lot less costly to the corporation, literally a 40% reduction. It was always attractive, 65 versus 35. It was always attractive. Now it's just become more attractive. And this is to the corporation. To the employee, they could care less. It's the same amount of money they were going to get otherwise, right? But to the corporation, all the current stuff being done, bonuses, deferred comp, all the usual tools that everybody else is competing with, is literally costing the corporation almost 4 times more than doing Trizen in this example. Does that answer your question?
So what if the company will be stopping from the deferred compensation completely altogether?
Well, it's the simple thing that everybody would. There's nothing that stops them saying, "I don't want to do deferred compensation anymore, and I want to do Trizen instead." In fact, I think there's a very strong business case for them to want to do that. And a lot of the inquiries that we're getting is when agents have gone in, they've done the discovery on the client, and they found that they have a deferred compensation plan. And the first question, nice open question that you can ask is, "Are you happy with it?" No, it's a pain in the neck. We've got all the admin. It's just become more expensive. Employees still don't think it's worth it, la, 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 la. How about you stop that and start doing Trizen? It's a great opportunity for you. But what we're saying is there's some really strong business reasons that they would actually want to do that now. Whereas before, they had the reasons before. This has just become nicer. Okay, so this is one of the gifts from the Tax Reform Act that has been given to help you. The other thing about the Tax Reform Act is because everybody's looking at this, normally, when you just buy a house and somebody comes to you after you've bought the house and says, "Hey, I've got a great house for you." Well, that's great, but you're not in the market anymore. Well, the same is true with benefits. People look at their benefits, once a year or once every 4 years if it's deferred compensation and stuff. Because of the Tax Reform Act, everybody's reviewing their benefit plan. So this is a perfect time for you to be having that conversation. Does that make sense, Andre?
Yes, it does. And this $21 net cost. Is it somehow related to the deduction of $21 under the new rules, or just a coincidence?
This is the new rules that we're talking about, the $21.
The first column of 21 and the second column.
So this is the tax you paid, and this is the cost. Am I misunderstanding your question?
Yes, you do. So you got 4 columns. You got 4 columns. Right. The second column from the left.
Okay, this one?
Yes.
Okay, so what this is saying is that this was the deduction I had. So this is my savings, for want of a better phrase, right? I was saving $35 before because I could offset tax. Now it's 21. It's just coincidence. It's just coincidence that in this regard, because it's the same tax code I'm applying, right?
Okay.
All right. Now, so let me just. I'll remute you, Andre, and I'll see if there's any other questions or other hands patiently waiting. No. Okay. I think I've covered the questions. Then, guys, this is a much shorter presentation than usual because we were just focusing on one aspect, which is the business perspective. Oh, sorry, hands raised. I'm going to say this badly, and I apologize in advance. Esa Hokela, am I said that right? Did I butcher? Close enough that I'm not going to be too embarrassed when I meet you, right?
I've been called a lot worse.
How? So, well, I'll settle that for that as a win. How can I help you today?
Anyway, the question I have is, I understand that you will assist us when we discover these cases. And my question, if you could recap a little bit on how that works and at what point would you get involved in the case?
That's actually a really good question because it really comes to the heart of the difference between Trizen and an enhanced split dollar. So we've kind of created this arbitrary line in the sand between Trizen and enhanced split dollar. So let's first of all deal with Kaizen. Kaizen, think of us as your tech support. When you start getting asked questions by the client or CPA, by all means put us on the phone. That's not a problem. But Kaizen's relatively straightforward because it's just a bonus plan. People overcomplicate it, but that's really what it is. When it comes to split dollar, the biggest problem you run into is the vast majority of clients and their accountants have no clue about split dollar. And so what we did on Trizen, Trizen's really focused at the larger case, so it's above 15 lives. And it's a kind of an arbitrary number, and you'll have to forgive us for that. So basically what happened is there's a whole bunch of Section 79 plans out there that are coming up for a renewal, except nobody's doing Section 79 anymore. Well, Trizen or enhanced split dollar is a natural successor for that. But nobody wanted to pay the enhanced split associated with bringing a CPA or an attorney online to answer the accounting and the legal questions associated with how do you account for split dollar. Let's be clear about this. Accounting and common sense aren't necessarily the same thing. There's some fairly convoluted accounting that comes up depending on how the company is running its reports. And also, those accounts have to be approved by the auditors. So you need somebody who can talk to auditors, the treasurer, the tax guy, the CFO. So we've retained that within Trizen. That's why the splits are bigger on Trizen. So what I would say there in answer to your question is, if you're in front of a large public company, do the qualification, but start to get one of the NIW team involved relatively quickly. And then we will bring in that attorney or CPA that we've retained and are paying for to answer all those questions. And I'll be candid, it very quickly goes into the land of weird, wonderful, funky stuff that unless you're in the space, I have no clue even what they're talking about most of the time when it comes to accrual accounting or the sort of more convoluted aspects of split dollar law. But they do that, right? Now, enhanced split dollar, most people didn't want to pay that because of the smaller cases. And so National Life's advanced marketing team, we haven't got the other carriers' confirmation on this, but I'm sure they're willing to do it. But in the case of National Life, their advanced marketing team are happy to be answering those questions, but you don't have the same level of support unless you ask for it to be a Trizen case. So what I would say in answer to your question is there's a lot of discovery that needs to go on this. What's the fact pattern? What are they doing now? What is their concern? That discovery you guys should probably be able to do. But once you start to get past that, after the initial, I'll call it elevator pitch, and they're starting to want to have more serious presentations, particularly if it comes to Trizen and enhanced split dollars, that's when you should reach out to one of our regional guys or one of us here at the home office to give you more support and answer those questions. And then as it starts to get deeper into that, like for example, there's some very large hospital groups with thousands of physicians. They are monster cases, but they also have a due diligence team from hell. Get us involved pretty early on those when you're starting to get to that stage. Did that answer your question?
Yes, it does. Thank you very much.
Okay, let me see if I can find you again with my screen upgrading so quickly so I can mute you, which of course I can't do now. While I'm doing that, Matt, Chauncey, let me just unmute you. Do you have a question?
I do. I'm looking at the screen that you have, or the page that you have up on the screen, and I'm trying to just make sure that it makes sense to me. And I apologize. I know you've gone through it a couple times. Scenario one in the old rules, that is a bonus that's being paid to the employee, or that's a loan that's being made to the employee?
Okay, so for column one, old rules, bonus and deferred compensation. Okay. Then there's old rules loans, which are Trizen and enhanced split dollar, just split dollar. So, take all the split out of it. It's just a loan. Okay. So you got old rules here. The first column is deferred compensation, bonuses. This is all the same stuff, right? Because it's all going to be, I pay you something, I take the deduction for it as a C corp. Yeah.
Okay, so they're paying the $100 to the client and to the employee, and for every $100 they pay to the employee at the corporate tax rate of 35%, they're getting a 35% deduction, is what you're saying?
That is correct. So the way they're looking at this, it's really costing them 65, right?
Gotcha. So, and 65 is the amount that's actually being funded into the plan because taxes had to be paid, because the net amount is what can be funded into the deferred comp plan, correct?
Okay. No. So what happens with deferred comp, remember they don't actually give you the money in deferred comp until you take it out. And there's some reasons behind that, because you get taxed on it otherwise, right? So it's all called that famous phrase, informal funding. So they'll be funding the cash into the plan, but when they actually pay it out, for every dollar they pay out, they'll take a deduction. So the amount of money you're getting, you will get your personal tax rate taken off this, right? But from the corporate point of view, they're only taking the deduction for the 35. So the way they're looking at it is that 35 is offsetting profit elsewhere. So my real cost is 65.
Okay, gotcha.
Yep.
Okay, so
now we reduce our taxes down, which everybody thinks is great until you happen to be in the deferred comp space. Now I'm still paying the same $100 out. Now I can only take a $21 deduction because the tax rate got reduced. So it's really costing me $79 now. So it got more expensive. It's kind of inverted thinking. Taxes come down, so something got more expensive to me. That's the weird convoluted world.
You're not getting as big a deduction for doing it, so it's money that would have been left or retained in the company to do other things with. Yeah, there's a cost.
Exactly. It's just we have to spell it out, because when people think taxes reduce, everything gets cheaper, right? Well, not really, not to the company.
Sure.
And so that's the before and after for deferred comp. And then when we look at loans, old rules, new rules, same logic, right? $100, but my loans are after tax. So before I would have paid the tax on that profit. So my real cost was 35. Now on the same profit, I'm paying $21, so my cost comes down. Does that make sense now?
Sure, but okay, but that cost, so in the Tri-ZEN scenario, it's not actually the funding of the deferred comp, it's the loan that's technically made to the employee, correct?
Well, okay, so the first thing, and actually you've just raised a really important question. Split dollar loans, to the employee, they may regard them as compensation or benefits, but from a tax point of view, they are not compensation at all. And that is why there's no deduction here.
For the employer.
For the employer, right? To the employee, it's $100 that I'm not paying tax on because it's a loan.
Okay.
Right? That's why it's a pre-tax plan.
Okay.
But to the employer, it's not. It's a loan, and all my loans that I do, whether it's to you or to any other loan I make, it's an after-tax payment, and therefore I would have paid tax on $100 of profit. So if my cost is the tax, I would have paid on that. Make sense?
So the business would have earned $100, paid tax on $100 earned at whatever the current tax rate was under the old rules, and then afterwards, after they paid the tax on the $100 earned, they would have then loaned the $100 out to the employee for the deferred comp.
Correct. So their real cost is 35 or 21, depending on which tax bracket you're in.
Gotcha. So now what you're saying is the business earns $100, the business pays tax on $100 at 21 cents on the dollar, and then they loan that $100 on an after-tax basis to the employee, which is now after-tax dollars that's being loaned, so they pay taxes on it at a lower rate. The employee is receiving a loan and not currently paying taxes on it, so then the net cost is 21 bucks.
And they never will pay tax on it unless the employer forgives the loan. That's one of the, I mean, let's be honest, if you haven't got enough money for retirement, and all the studies say this, Fidelity and all the rest of it say this, when you retire, you're going to spend the same amount of money as you're spending today. You're just going to spend it on different things like healthcare and medical expenses and stuff like grandkids and things like that. So if you don't have enough money, losing 40% of it is a big hit, which is one of the advantages of having either the Kaizen plan or the Tri-ZEN plan, is that you're no longer paying tax, right? That's one of the big advantages of life insurance that most people are not aware of.
So how does the loan get retired in the new rule scenario with Tri-ZEN? How does that loan get retired to the employer without the employee incurring income tax?
Right. So what happens here is, because this is kind of the non-compliant way to describe loan regime split dollar. I'm going to lend you $100 that you otherwise would have paid 37% tax on, right?
Sure.
And let's take 10% or whatever the right amount is, but it's normally between 10 and 15% of that $100 to buy life insurance that pays me back when you die, so you don't have to worry about it.
Okay.
Now, you don't pay tax on a loan as long as you pay the loan back. And that's what, if you think about it, we have so much more money available on a pre-tax plan that if you're doing a minimum face, maximum solve, if I increase the premium, I'm driving up the death benefit. Can't help it. Otherwise, I run into a MECRL issue, right?
For sure.
So that extra insurance, and typically that extra insurance is like $1.5 million extra insurance on a typical case we see. And the typical loan, if we did this $500, compounded it at the AFR rate to well beyond your life expectancy, that's going to be like $800 to $900 you have to pay me back. So I've got $1.5 million to pay $800-900 back. So I've got plenty of death benefit to pay back. So there's no tax because the life insurance pays the loan back in full with interest. So that's why there's no tax.
So the exit on the payback in this structure is the death of the executive.
Well, no, that's what it can be. What we actually do is, now this is not on the designs you saw last year, but if you look at the designs that we have been sending out recently, we've taken the policy loans out from 65 to 90. And what we've then done is a couple of years after that, had a quick look, and we found we have enough cash value that we can pay back the entire split dollar loan from surplus cash value still, because we're not pulling out all the money we possibly could from the contracts. So either death or actually in the NIW designs for enhanced split dollar or Tri-ZEN that you'll see now, you'll actually see a split dollar loan exit a couple of years after we stop taking income from the policies.
Because I was going to say, because there's two exits, because your company, ZEN, still has to get their money back out from funding the loan, and you guys typically take your loan back out in 15 or 16, so you guys have to get your loan proceeds back out first before the employer can get their loan proceeds back out, correct?
Yeah, that's true, but it's not difficult to do that because the death benefit's gone up so much because of the I mean, if you think about it, you save the 30-40% money that you would have paid as tax on a bonus plan, but we're then leveraging it up again. So there's actually 80% more cash going into the policy.
Sure, because
and even with Titan.
Because, and I'm just for simple numbers, because what you're suggesting in this scenario is if the business is loaning that highly compensated employee $100,000, then with your structure, you guys are also loaning that employee $100,000. So it's $200,000 actually going into the structure, correct?
That is correct. That's why there's so much more money at play here.
Okay, I'm tracking. And so in this scenario, what you're suggesting, business earns $100,000 of income, they pay 21% tax on it. They then do that for 5 years. Every year they loan that executive $100,000. You guys also loan that executive $100,000 over those first 5 years. So now there's $200,000 a year for 5 years, or $1 million that's funded into the policy. Then you continue to loan that policy year 6 through 10 an additional $1 million. And so now there's been $2 million funded in the policy. Year 16, ZEN has the ability to exit and take their money back out. And there's still $500,000 of a loan that was made from the employer to the employee to the executive that can be exited out, pay back the company later, and then the client, the highly compensated executive, is going to own that, reduced, paid up with no outstanding loans against the policy after year somewhere between 16 and 20.
Yeah, we typically don't take the split dollar loan out that quick, because otherwise you just wouldn't have enough cash to really pull as much money out of the policy. What we actually do is we pay off the bank after the 15th year. We then take policy loans from it, and then after age 90, if the person is still alive, we just take the surplus cash value and pay back the loan at that point.
Gotcha. Okay, makes sense.
Okay.
I understand. Yeah, I just wanted you. Thanks for just taking.
I think you were asking the question, Matt, that a lot of people wanted to ask, so I appreciate you asking the question. I'm going to remote your phone because I've got another question to get to, okay?
Thank you.
All right, then, I'm just scrolling down. There's another question I need to try and get to, so bear with me a second. Now, I'm fairly certain that everybody's doing this just to give me the more difficult names to pronounce, so again, I'm going to apologize in advance. Is it Teig Salmons?
Yes, Teig, you got that right. That was very good.
Oh, thank God. I'm not butchering everybody's names. Teig, what's your question, sir?
That's rare that somebody would get that right on round one. So kudos to you. My question is, on this particular slide that you have up, the power in this, I'm just going to run the scenario by if I'm understanding it correctly. So the new rules, essentially, if it's a bonus or deferred compensation, the company would pay $79 for every $100 the net cost would be $79 to the company for every $100 loan. Now, could an argument be made then, let's say, for example, with a relatively large physician group, say they've got 60, 70 physicians, they're all getting bonused up at $100,000. Obviously, they're really only netting probably $60,000 of that money at the end of the day after they've paid taxes. And say, let's call that a ZEN type situation. So would it make sense, logically, you say, look, instead of giving you guys $100,000, we're going to give you $200,000 or even more in the form of a loan in a Tri-ZEN scenario. Now you can imagine obviously the leverage that you gain from that additional, say $500,000 in years 1 through 5. And it could even be more, because if you're looking at the difference between a $79 net cost to the company and and a $21 net cost to the company, you could darn near triple what you were paying them in the form of a traditional bonus that's taxed on personal income versus doing a Tri-ZEN scenario. So if you were to show and describe those two side by side, what a Kaizen program would look like, or just some other form of investment vehicle that they would be using with, say, that $60,000 net dollars per year versus $200,000, $250,000, whatever number that the company would land upon in doing a Tri-ZEN scenario. Because from a cost to the company, you're looking at $21 per 100 versus $79 per 100, which is very significant. So, can you talk?
I've got the question. Yeah, I've got the question.
Yeah.
I think that there's nothing wrong with your logic other than making sure they have the cash flow to do it, right? Because at the end of the day, from a cash point of view, all these plans are paying out $100. You're right that the cost, right? So, but assuming now, let's be blunt about this. Doctors groups are very keen to figure out how they can pay themselves the most money in the most tax efficient way. So if they have the cash flow to do it, you absolutely made a very strong argument about, from a business point of view, you're basically net neutral except the cash, which is going to you guys anyway. So why wouldn't you do that? Well, you do that, and then let's not lose sight of the fact that most of these doctors groups, their exit strategy is to sell that doctors group at some point, and there's an awful lot of M&A activity going on there right now. And that's why I also, in one of those later slides, I had no idea this was going to be such an interesting slide to everybody, but but also why I did a valuation of what would that asset actually be worth. Because let's not forget, for every $100 they're lending, there is an asset value back to the firm which they can use as part of their sell price. So I think your argument is a very sound one. I think it's good as long as they have the cash flow. So basically you get them thinking around this number, and then it's really going to be limited by how much of this they want to play. But then you point out that you're also kind of augmenting their exit strategy by doing this strategy, whereas deferred comp, big bonus plans and deferred comp actually reduce the company value, not just because of the money that's being paid out, but because also the cost of ongoing servicing of it will come back to bite them when it comes to actually selling the company later. So I think that's a good angle.
Well, and your point too, which I was thinking of the exact same thing, was if you've got $100,000 of typical, vanilla bonus going out, there's absolutely no upside on the books for the company for that whatsoever, except for just an expense. Whereas if you turn it into a Tri-ZEN program, you actually have an asset on the books. So let's say that you don't double it to 200,000, whatever the number is that they're comfortable with from a cash flow issue, because like, as you pointed out, that would be the most important component of this argument. But if from a financial perspective, it's a no-brainer to move from a typical bonus structure to Tri-ZEN, provided also that that was the other part of my question, was you need to have all of the individuals that were bonused on board with this Tri-ZEN program, because now technically they're not getting a cash bonus, they're getting a loan to an investment vehicle strategy that's extremely powerful, and they'd have to be on board with that and understand it. To say, yeah, we would rather do that than just get our $100,000 bonus and pay 40%, income tax on it, right?
One of the arguments you can make here is most people's investment in their own company is a deferred investment, if you think about it. And you can make the argument by doing this, they're making that deferred investment a permanent non-taxable investment. So I think, one of the things people get, they go, well, hang on, why am I having to pay back money that was due to me? And I keep saying to them, you're not paying back money that was due to you. You're paying back money, a fraction of which, that otherwise you're using a fraction of the money that you would have lost to taxes to pay back, and that's the only way you can make this a pre-tax plan. So I try to use very simple analogies for the split dollar because we like throwing out jargon, but the client doesn't care about that. It's really, how does this help me get more money? So I think if you can keep it simple and use kind of the analogy you had is a strong one. Okay?
Yeah, you're leveraging the arbitrage of that money between your rate of return versus your interest rate you're paying out on other people's money, essentially over a period of a relatively long period of time. Say it's 15, 16 years, and you look at the income stream that can generate, If you were to turn that income stream into actual dollars, you would have in some other investment, for example, and you're taking that money out pre-tax, you're just giant numbers. I mean, the numbers are, you'd have to have a huge piece of money sitting somewhere to draw out, say you've got $300,000 in income, you got to take out what, 500,000 plus a year just to make the 300,000. I mean, you start looking at.
So what I say here, what I say is, I always say you're leveraging the money that you'd otherwise be paying as tax, right?
There you go.
In terms of the logic of the leveraging, the data is very clear on this. The value of the IUL is its downside protection, right? I mean, that changes your risk profile. But the value of the leverage is that on average you'd expect. I mean, think of this as a margin loan. I'm stealing Grace's analogy, but think of this as a margin loan. Everybody has access to margin loans, but very few people use them because of the risk. But if you had the margin loan with no downside risk, right, then everybody would use margin loans. So all you're really worried about is, will the average performance of the IUL outperform the loan by, actually in the case of Kaizen, about 0.9% or less. And we know the actual data. If you're getting the loan rates of LIBOR plus 175, which is what we're getting, we know the data says you're expecting to outperform it by 2.25%. And if you hold it for 15 years with a 99.999% level of certainty. I mean, this is very, very risk balance. We've done everything we can, and I know this will shock you because we built it for ourselves, right? So if you're designing it for yourself, what's the first thing you do is minimize risk and maximize return. But basically, we've taken the learning from our traditional premium finance business and said, how do we make this uber safe for both the bank and the employee to participate? Now, the reason I said that is because at the beginning of the presentation, I said in traditional plans, so you think about deferred compensation and bonus plans, people take that money and they invest it in what? Stocks. Diversified stock portfolio, you've only got a 72% hit rate versus a 99.999% hit rate with us. So I think not only are we bringing more money, we're bringing more certainty of your outcome, because you're absolutely down the tubes if that market correction happens just before you retire. I think we monopolized the conversation on this another day, but
yeah, in the stocks, when you start to draw that money out, you're paying income tax on those dollars.
Indeed.
Versus the Trident, which is that's just that alone. Even if all things were equal, when you go to draw that money out, so you're getting a 99.99% rate versus 72% hit rate, and then you're also drawing that money out in the form of policy loans with no income tax associated with them. It's really powerful.
And you have 400% more money at play. All right, so if I may, I'll mute you. I'll just see if I can get some other people answering their questions. Let me just check very quickly. This is when you're at the mercy of me scrolling through this wretched page to find any hands that are raised. Actually, I think we're good. Guys, as always, I know you're busy on Friday. I really, really appreciate your questions. We'll be putting the speaker's notes on this particular presentation over the next couple of hours, and then we'll make it available for those of you who want it. I hope it gave you some employer perspective, some stuff that when you're talking to the owners of the company as opposed to the employees of the company on some of the value from a company point of view. That was the objective of this particular presentation. I hope it did that. Any feedback, both positive and negative, would be most welcome. That notwithstanding, guys and ladies, please have a fantastic weekend and good hunting out there.